Question 1. To address the challenge of accurately reflecting a complex new hedging instrument in Grupo, Mexico's financial statements, which of the following approaches best ensures compliance with applicable accounting standards and regulatory disclosure requirements? Option A. Consulting the legal department for their interpretation of the hedging instrument's contractual terms and applying the accounting treatment that aligns with their legal opinion. Option B. Conducting a detailed analysis of the hedging instrument against the specific accounting standards and relevant guidance issued by the authoritative accounting standard setter for Grupo Mexico's jurisdiction, and documenting the rationale for the chosen accounting treatment. Option C. Applying the accounting treatment based on the general understanding of hedging instruments within the industry, without specific reference to the authoritative accounting pronouncements. Option D. Prioritizing the immediate recognition of any potential gains from the hedging instrument to present a more favorable financial position in the upcoming quarterly report. Correct answer is C. Applying the accounting treatment based on the general understanding of hedging instruments within the industry, without specific reference to the authoritative accounting pronouncements. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under stringent regulatory oversight. The challenge lies in balancing the need for timely and accurate financial reporting with the imperative to adhere strictly to the accounting principles and disclosure requirements mandated by the relevant regulatory bodies. Misinterpreting or misapplying these principles can lead to material misstatements, regulatory sanctions, and damage to investor confidence. Careful judgment is required to ensure that all financial transactions are recorded and presented in a manner that is both compliant and transparent. Correct approach involves a thorough review of the transaction against the specific accounting standards applicable to Grupo Mexico's operations and reporting jurisdiction. This includes consulting relevant pronouncements from the authoritative accounting standard setter, and, if necessary, seeking clarification from internal or external experts. The justification for this approach is rooted in the fundamental principles of financial reporting, which demand accuracy, completeness, and compliance. Adhering to established accounting standards ensures that financial statements present a true and fair view of the company's financial position and performance, thereby fulfilling legal and ethical obligations to stakeholders and regulators. An incorrect approach would be to rely on informal interpretations or industry best practices that are not explicitly supported by the applicable accounting framework. This is a regulatory failure because it bypasses the established authoritative guidance, potentially leading to noncompliance. Another incorrect approach would be to prioritize speed of reporting over accuracy and compliance. This is an ethical failure as it compromises the integrity of financial information, which is crucial for informed decision-making by investors and other stakeholders. Furthermore, it could lead to a violation of disclosure requirements, resulting in penalties. Professionals should employ a systematic decision-making process that begins with identifying the relevant accounting standards. This is followed by a detailed analysis of the specific transaction in light of those standards. If ambiguity exists, seeking expert advice or consulting authoritative interpretations is essential. The final step involves documenting the rationale for the accounting treatment applied, ensuring transparency and auditability. This structured approach minimizes the risk of error and ensures compliance with regulatory expectations. Question 2. The review process indicates that Grupo Mexico's internal finance team is considering adjustments to the current period's financial reporting to mitigate the impact of an unexpected increase in operational costs. Specifically, they are exploring options to defer recognition of certain expenses or reclassify them to better align with historical profitability trends. Which of the following approaches best adheres to the regulatory framework and ethical standards applicable to Grupo Mexico? Option A. Reclassify significant operational expenses as capital expenditures where possible, even if the primary benefit is not expected to extend beyond the current reporting period, to reduce current period's reported expenses. Option B. Interpret accounting standards liberally to defer the recognition of all non-essential operational costs until future periods when profitability is projected to be higher. Option C. Omit detailed disclosures about the reasons for the increase in operational costs, focusing instead on positive aspects of the company's performance to maintain investor confidence. Option D. Accurately recognize all expenses and liabilities in the period they are incurred according to Mexican financial reporting standards, NIF, and provide complete, transparent disclosures regarding any material variances from expected performance. The correct answer is D. Accurately recognize all expenses and liabilities in the period they are incurred according to Mexican Financial Reporting Standards, NIF, and provide complete, transparent disclosures regarding any material variances from expected performance. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's operational needs and the stringent regulatory requirements governing financial reporting and disclosure. Grupo Mexico, as a publicly traded entity, is subject to specific Mexican securities laws and accounting standards that mandate transparency and accuracy in financial statements. The challenge lies in balancing the desire to present a favorable financial picture with the legal and ethical obligation to report all material information truthfully, even if it reflects negatively on short-term performance. Careful judgment is required to ensure that any adjustments or interpretations of accounting principles do not cross the line into misrepresentation or omission of material facts, which could lead to severe legal penalties and reputational damage. The correct approach involves a thorough and objective assessment of the financial data, adhering strictly to applicable Mexican financial reporting standards, NIF, and relevant provisions of the Mexican securities market law, Ley del Mercado de Valores. This means recognizing all liabilities and expenses as they are incurred, even if they impact profitability, and ensuring that disclosures are complete and not misleading. This approach is correct because it upholds the principles of transparency, accuracy, and compliance, which are fundamental to maintaining investor confidence and fulfilling legal obligations. It aligns with the ethical duty of professionals to act with integrity and in the best interest of the company and its stakeholders, as guided by professional accounting bodies in Mexico. An incorrect approach that involves selectively interpreting accounting standards to defer or minimize the recognition of current expenses would be a failure to comply with the accrual basis of accounting, a core principle in NIFs. This could lead to an overstatement of current profits and an understatement of liabilities, violating the principle of fair presentation. Another incorrect approach, such as omitting disclosures about potential contingent liabilities that are probable and estimable, would be a direct violation of disclosure requirements under Mexican law and NIFs, potentially misleading investors about the company's true financial position and risks. A third incorrect approach, which might involve classifying operational expenses as capital expenditures without proper justification according to NIFs, would constitute accounting misstatement and misrepresentation, undermining the reliability of Grupo Mexico's financial statements. The professional decision-making process for similar situations should involve a systematic evaluation of the facts against the relevant regulatory framework. This includes consulting with internal legal and accounting experts, seeking external professional advice if necessary, and documenting the rationale for all significant accounting judgments and decisions. Prioritizing compliance and ethical conduct over short-term financial gains is paramount. Question 3. What factors determine the appropriate framework for implementing new internal controls at Grupo Mexico, ensuring full compliance with Mexican financial regulations and corporate governance standards? Option A. A cost-benefit analysis focused on the most economical solutions for control implementation, irrespective of specific jurisdictional requirements. Option B. A detailed analysis of Mexican financial market laws and CNBV regulations, alongside relevant corporate governance codes applicable in Mexico. Option C. The delegation of the entire control implementation process to an external audit firm without internal verification of Mexican regulatory adherence. Option D. A review of general international best practices for internal controls, as commonly adopted by multinational corporations. The correct answer is B. A detailed analysis of Mexican financial market laws and CNBV regulations, alongside relevant corporate governance codes applicable in Mexico. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates within a highly regulated environment. The implementation of new internal controls requires a thorough understanding of and adherence to the specific legal and regulatory framework governing its operations in Mexico. Failure to correctly identify and apply these requirements can lead to significant legal repercussions, financial penalties, and reputational damage. The challenge lies in navigating the complexities of Mexican financial regulations, corporate governance codes, and potentially industry-specific rules to ensure the new controls are not only effective, but also compliant. The correct approach involves a comprehensive review of Mexican financial market laws, such as the Ley del Mercado de Valores, and relevant regulations issued by the Comisión Nacional Bancaria y de Valores, CNBV. This approach is correct because it directly addresses the legal and regulatory obligations of Grupo Mexico. By consulting these specific Mexican frameworks, the company ensures that its internal controls are designed and implemented in accordance with the standards set by the primary financial regulator. This proactive compliance is essential for maintaining market integrity, protecting investors, and avoiding sanctions. An incorrect approach that relies solely on general best practices without specific regulatory grounding is professionally unacceptable. This failure stems from a lack of jurisdictional specificity, ignoring the mandate to adhere to Mexican laws. Such an approach risks overlooking critical local requirements, leading to non-compliance. Another incorrect approach that prioritizes cost efficiency over regulatory alignment is also flawed. While cost is a consideration, it cannot supersede legal obligations. Implementing controls that are cheaper but do not meet regulatory standards exposes Grupo Mexico to significant risks. Finally, an approach that delegates the entire responsibility to external consultants without internal oversight or verification of compliance with Mexican regulations is also problematic. While consultants can provide expertise, ultimate accountability for regulatory compliance rests with the company and its management. Professionals tasked with implementing internal controls should adopt a systematic decision-making process. This begins with identifying the specific regulatory jurisdiction, in this case, Mexico, and then thoroughly researching the applicable laws and regulations from bodies like the CNBV. This research should inform the design and implementation of controls. A risk-based approach, prioritizing areas with the highest regulatory impact, is also crucial. Regular internal reviews and audits, coupled with clear communication channels between legal, compliance, and operational departments, are vital to ensure ongoing adherence and to adapt to any changes in the regulatory landscape. Question 4. Stakeholder feedback indicates that the proposed expansion project for Grupo Mexico's mining operations in a sensitive ecological zone may have significant environmental impacts that were not adequately addressed in the initial project proposal. What is the most appropriate course of action for Grupo Mexico to ensure compliance with Mexican environmental regulations and maintain positive stakeholder relations? Option A. Issue a formal response to stakeholders acknowledging their feedback, but stating that the original environmental impact assessment is legally sufficient and no further revisions are necessary. Option B. Initiate a public relations campaign to counter the negative perceptions of the project's environmental impact, emphasizing the economic benefits of the expansion. Option C. Proceed with the project as originally planned, assuming that any environmental concerns can be addressed through routine operational monitoring and minor adjustments after commencement. Option D. Conduct a supplementary environmental impact assessment that specifically addresses the concerns raised by stakeholders, incorporating their feedback into revised mitigation strategies and project plans, and engaging in further public consultations to present these revisions. The correct answer is D. Conduct a supplementary environmental impact assessment that specifically addresses the concerns raised by stakeholders, incorporating their feedback into revised mitigation strategies and project plans, and engaging in further public consultations to present these revisions. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to expand its operations and the need to adhere strictly to the regulatory framework governing environmental impact assessments and public consultation in Mexico. Grupo Mexico must navigate these requirements while managing stakeholder expectations, which can be diverse and sometimes conflicting. Careful judgment is required to balance business objectives with legal obligations and social responsibility. The correct approach involves a proactive and transparent engagement process that fully integrates stakeholder feedback into the Environmental Impact Assessment (IA) process, as mandated by Mexican environmental law and regulations. This means not only soliciting feedback, but also demonstrating how that feedback has been considered, and where feasible and legally permissible, incorporated into the project plans and mitigation strategies. This approach ensures compliance with the spirit and letter of Mexican environmental legislation, which emphasizes public participation and the minimization of environmental harm. It builds trust with stakeholders and reduces the risk of legal challenges or project delays. An incorrect approach that focuses solely on meeting the minimum procedural requirements for public consultation without genuine engagement or consideration of feedback would be professionally unacceptable. This would violate the principles of good governance and environmental stewardship embedded in Mexican regulations. Such an approach risks alienating stakeholders, leading to reputational damage and potential legal repercussions for noncompliance with the participatory aspects of the EIA process. Another incorrect approach, which involves dismissing stakeholder concerns as purely obstructive without objective evaluation against regulatory criteria, is also professionally unsound. Mexican environmental law requires a substantive review of all feedback received during public consultations. Ignoring valid concerns or failing to address them through appropriate mitigation or project adjustments would constitute a failure to comply with the regulatory mandate for thorough environmental review and public accountability. Finally, an approach that prioritizes expediency over thoroughness by rushing the EIA process and public consultation phases would be a significant professional failure. Mexican environmental regulations are designed to ensure a comprehensive assessment of potential impacts. Expediting these processes without adequate time for review, feedback, and incorporation of necessary adjustments undermines the integrity of the EIA and exposes Grupo Mexico to regulatory penalties and public backlash. Professionals should approach such situations by first thoroughly understanding the specific Mexican environmental laws and regulations applicable to the project, including the requirements for EIAs and public consultations. They should then develop a stakeholder engagement plan that is robust, transparent, and designed for genuine dialogue. This plan should include mechanisms for documenting feedback, analyzing its relevance and feasibility, and communicating how it has been addressed. A commitment to ethical conduct and regulatory compliance should guide all decision-making, ensuring that business objectives are pursued responsibly and sustainably. Question 5. The monitoring system demonstrates a recurring discrepancy in the reported inventory valuation for a key raw material used in Grupo Mexico's mining operations. The discrepancy appears to be a consistent underreporting by approximately 2% over the last quarter. What is the most appropriate immediate course of action for the compliance officer to take? Option A. Monitor the situation for another month to see if the discrepancy self-corrects before taking any further action. Option B. Initiate a detailed, documented investigation involving the logistics and accounting departments to identify the root cause of the underreporting, reviewing inventory management procedures and transaction records. Option C. Immediately report the discrepancy to the Chief Financial Officer and the external auditors, requesting an urgent review of all inventory valuation processes. Option D. Manually adjust the current inventory valuation figures to reflect the historical 2% underreporting, assuming it is a systemic data capture error. The correct answer is B. Initiate a detailed, documented investigation involving the logistics and accounting departments to identify the root cause of the underreporting, reviewing inventory management procedures and transaction records. Explanation. The monitoring system demonstrates a potential breach of internal controls and regulatory compliance for Grupo Mexico. The challenge lies in identifying the root cause of the discrepancy and implementing corrective actions swiftly and effectively, while adhering to Grupo Mexico's internal policies and relevant Mexican financial regulations. This requires a nuanced understanding of data integrity, reporting accuracy, and the ethical obligation to maintain transparent and compliant operations. The correct approach involves a thorough, documented investigation into the discrepancy, involving relevant internal departments and potentially external auditors if necessary, to ascertain the cause and implement remedial measures. This aligns with Grupo Mexico's commitment to robust internal controls and the principles of accurate financial reporting mandated by Mexican regulatory bodies. It ensures that any identified issues are addressed systematically, preventing recurrence and maintaining stakeholder confidence. An incorrect approach of immediately escalating the issue without a preliminary investigation risks creating unnecessary alarm and diverting resources. It fails to demonstrate due diligence in understanding the problem before involving higher authorities or external parties. Another incorrect approach of attempting to manually adjust the data to match expectations without understanding the underlying cause is a severe ethical and regulatory failure. This constitutes data manipulation, which undermines the integrity of financial reporting and can lead to significant legal and financial penalties under Mexican law. It also bypasses established internal control procedures designed to prevent such occurrences. A further incorrect approach of ignoring the discrepancy, hoping it resolves itself or is a minor anomaly, is professionally negligent. This demonstrates a lack of commitment to compliance and risk management, potentially exposing Grupo Mexico to significant regulatory sanctions and reputational damage. Professionals should approach such situations by first acknowledging the detected anomaly. Then, they should initiate a structured investigation, gathering evidence, consulting relevant policies and regulations, and collaborating with appropriate stakeholders. The goal is to understand the why behind the discrepancy before proposing solutions. This systematic process ensures that actions taken are compliant, ethical, and effective in strengthening internal controls and maintaining the integrity of Grupo Mexico's operations. Question 6. Stakeholder feedback indicates a potential misstatement in Grupo Mexico's latest quarterly earnings report. What is the most appropriate initial course of action for the company's investor relations department to address this feedback? Option A. Disseminate the information regarding the potential misstatement through Grupo Mexico's official social media channel to reach a broad audience. Option B. Conduct a thorough internal review with legal and finance departments to verify the accuracy of the feedback before any external communication. Option C. Immediately issue a press release clarifying the potential misstatement to assure investors. Option D. Advise the stakeholders who provided the feedback to consult the publicly available financial statements for clarification. The correct answer is C. Immediately issue a press release clarifying the potential misstatement to assure investors. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under strict regulatory oversight concerning its financial reporting and disclosure obligations. The challenge lies in balancing the need to address stakeholder concerns promptly with the imperative to ensure all communications are accurate, complete, and compliant with applicable Mexican securities laws and regulations. Misinformation or premature disclosure can lead to market manipulation accusations, investor distrust, and significant legal and reputational damage. Careful judgment is required to determine the appropriate channel and content of communication. The correct approach involves a structured, internal review process that prioritizes factual verification and regulatory compliance before any external communication. This approach is best professional practice because it ensures that any information released by Grupo Mexico is accurate, not misleading, and adheres to the disclosure requirements mandated by the Comisión Nacional Bancaria y de Valores, CNBV, and relevant stock exchange rules. By consulting with legal and compliance departments, the company can ensure that its response is legally sound and ethically responsible, protecting both investors and the company's integrity. An incorrect approach of immediately releasing a public statement without internal verification fails to uphold the duty of accurate disclosure. This could lead to the dissemination of unconfirmed or potentially false information, violating principles of fair disclosure and potentially contravening CNBV regulations on market integrity. Another incorrect approach of ignoring the feedback entirely or delaying a response indefinitely neglects the responsibility to address legitimate stakeholder concerns in a timely manner. This can erode investor confidence and may be viewed as a failure to engage with the market, potentially leading to scrutiny from regulatory bodies for lack of transparency. A further incorrect approach of communicating the information solely through informal channels, such as social media or direct conversations with select individuals, bypasses established disclosure protocols. This creates an uneven playing field for investors, as not all market participants receive the same information simultaneously, which is a direct violation of fair disclosure principles and CNBV regulations. Professionals should employ a decision-making framework that begins with acknowledging and documenting stakeholder feedback. The next step is to assess the nature and potential impact of the feedback. If the feedback pertains to material information, the company must initiate an internal investigation involving relevant departments, e.g., legal, finance, investor relations, to verify the facts. Only after thorough verification and consultation with legal and compliance teams should a decision be made regarding the appropriate form and timing of communication, ensuring full adherence to all applicable Mexican securities laws and CNBV guidelines. Question 7. Stakeholder feedback indicates concerns regarding the environmental impact of certain Grupo Mexico operations and a perceived lack of transparency in reporting. Management is considering implementing new operational procedures to improve efficiency and reduce costs. Which of the following approaches best addresses this situation in compliance with Mexican regulatory frameworks and ethical corporate governance principles? Option A. Prioritize cost reduction by implementing the most efficient operational changes immediately, with a plan to address any environmental concerns that arise after implementation. Option B. Conduct a thorough environmental impact assessment for all proposed operational changes. Engage in transparent communication with stakeholders about findings and mitigation plans, and ensure full compliance with SEMARNAT regulations. Option C. Implement operational changes that offer the greatest cost savings, and address stakeholder feedback on environmental impact through public relations efforts rather than substantive operational adjustments. Option D. Focus on improving internal reporting metrics to highlight operational efficiencies, while deferring detailed environmental impact studies until mandated by regulatory bodies. The correct answer is B. Conduct a thorough environmental impact assessment for all proposed operational changes. Engage in transparent communication with stakeholders about findings and mitigation plans, and ensure full compliance with SEMARNAT regulations. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, must navigate complex stakeholder expectations while adhering to stringent regulatory requirements. The challenge lies in balancing the desire for operational efficiency and cost reduction with the imperative to maintain transparency and ethical conduct, particularly concerning environmental impact and community relations. Careful judgment is required to ensure that any proposed changes do not inadvertently violate environmental regulations or erode trust with local communities and investors. The correct approach involves a comprehensive, data-driven assessment that prioritizes regulatory compliance and stakeholder engagement. This means meticulously reviewing existing environmental permits, consulting with relevant regulatory bodies, e.g., SEMARNAT in Mexico, and proactively engaging with affected communities to understand their concerns and incorporate their feedback into any revised operational plans. This approach is correct because it directly addresses the core of the stakeholder feedback by seeking solutions that are both economically viable and legally sound, thereby upholding Grupo Mexico's commitment to responsible corporate citizenship and regulatory adherence. It demonstrates a commitment to transparency and due diligence, which are foundational ethical principles in corporate governance, and are often reinforced by specific provisions within Mexican environmental and corporate law. An incorrect approach that focuses solely on cost reduction without a thorough environmental impact assessment would fail to comply with Mexican environmental laws, which mandate rigorous evaluation and mitigation of potential ecological harm. This could lead to significant fines, operational shutdowns, and reputational damage. Another incorrect approach that dismisses community concerns as secondary to operational efficiency would violate ethical principles of social responsibility and could contravene specific Mexican regulations that protect indigenous rights and community consultation processes. Such an approach risks legal challenges and further erodes stakeholder trust. A third incorrect approach that involves selectively reporting or downplaying environmental risks to stakeholders would constitute a breach of disclosure obligations and potentially mislead investors, violating principles of corporate governance and securities regulations. Professionals should approach such situations by first establishing a clear understanding of the regulatory landscape and the specific concerns raised by stakeholders. This involves a structured process of information gathering, risk assessment, and consultation. The decision-making framework should prioritize compliance, ethical considerations, and long-term sustainability over short-term gains. This means actively seeking input from legal, environmental, and community relations experts within Grupo Mexico, and where necessary, external consultants. The ultimate goal is to identify solutions that align with regulatory mandates, ethical standards, and the legitimate interests of all stakeholders. Question 8. The control framework reveals that Grupo Mexico has entered into several complex derivative contracts. A junior analyst has prepared an initial assessment suggesting that the accounting treatment for these derivatives, while potentially complex, will result in a favorable impact on the current quarter's reported earnings. However, the analyst's documentation lacks detailed explanations of the valuation methodologies used and does not explicitly reference the specific Mexican financial reporting standards, NIF, that support their proposed accounting treatment. The senior accountant is tasked with reviewing this assessment and determining the appropriate next steps to ensure compliance and accurate financial reporting. Option A. Proceed with the proposed accounting treatment as it positively impacts earnings, assuming the analyst's initial assessment is correct, and further detailed justification is not immediately necessary for internal review. Option B. Advise the analyst to adjust the valuation methodologies to ensure a more conservative impact on earnings, even if it deviates slightly from the most direct interpretation of the NIFs, to mitigate potential future scrutiny. Option C. Request the analyst to provide detailed documentation supporting the valuation methodologies and to clearly cite the applicable NIFs that justify the proposed accounting treatment, ensuring alignment with Grupo Mexico's internal control framework and regulatory requirements. Option D. Immediately reject the analyst's assessment and require a complete reevaluation of the derivative accounting from scratch without providing specific guidance on the deficiencies. The correct answer is A. Proceed with the proposed accounting treatment as it positively impacts earnings, assuming the analyst's initial assessment is correct and further detailed justification is not immediately necessary for internal review. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under stringent regulatory oversight. The core of the challenge lies in balancing the need for timely and accurate financial reporting with the potential for misinterpretation or manipulation of complex financial instruments. The pressure to present a favorable financial picture can create ethical dilemmas, requiring individuals to adhere strictly to accounting principles and regulatory guidelines. Careful judgment is essential to ensure that all disclosures are transparent, complete, and comply with the applicable framework. The correct approach involves a thorough and documented review of the derivative contracts, ensuring that their accounting treatment aligns precisely with the Grupo Mexico's established internal control framework and relevant Mexican accounting standards, NIF. This includes verifying that the valuation methodologies are appropriate, that hedge accounting criteria are met where applicable, and that all disclosures are comprehensive and transparent, reflecting the true economic substance of the transactions. This approach is professionally sound because it prioritizes compliance with accounting standards and regulatory requirements, fostering trust and accountability. It demonstrates a commitment to accurate financial reporting, which is a fundamental ethical obligation for any financial professional and a cornerstone of regulatory compliance for companies like Grupo Mexico. An incorrect approach that focuses solely on the immediate impact on reported earnings, without a comprehensive review of the underlying accounting principles and regulatory disclosures, would be professionally unacceptable. This failure to adhere to established accounting standards and disclosure requirements could lead to misstated financial statements, potentially violating Mexican securities laws and regulations. Another incorrect approach that involves selectively disclosing information about the derivatives, omitting details that might negatively affect the perception of the company's financial health, constitutes a breach of ethical conduct and regulatory obligations for transparency. Such selective disclosure can mislead investors and stakeholders, undermining market integrity. A third incorrect approach that relies on informal or undocumented justifications for accounting treatment, bypassing the established control framework, introduces significant risk of error and noncompliance. This lack of rigor and documentation makes it impossible to demonstrate adherence to regulatory standards and can be viewed as a failure of internal controls. Professionals should employ a decision-making framework that begins with a clear understanding of the relevant regulatory framework and accounting standards. This should be followed by a meticulous assessment of the specific financial instruments and transactions in question, ensuring that all accounting treatments are supported by robust documentation and align with the company's control policies. When in doubt, seeking clarification from senior management, internal audit, or external auditors is crucial. The ultimate goal is to ensure that financial reporting is not only compliant, but also accurately reflects the economic reality of the company's operations. Question 9. The assessment process reveals that a new client, a large industrial conglomerate with a long and publicly documented history of operations in Mexico, is seeking to open a significant account with Grupo Mexico's financial services division. While the client's public profile suggests low risk, the internal compliance team is debating the extent of Know Your Customer (KIC) due diligence required. Given the potential for large transaction volumes, what is the most appropriate approach to fulfilling Grupo Mexico's regulatory obligations in this scenario? Option A. Rely solely on the client's extensive public record and reputation, assuming a low-risk profile without further independent verification. Option B. Expedite the account opening process by performing only basic identity verification, as the client's size and public presence imply minimal risk. Option C. Conduct a risk-based due diligence assessment, applying enhanced measures only if the assessment identifies specific risk factors beyond the client's established public profile. Option D. Implement a comprehensive enhanced due diligence process for this client, mirroring the requirements for high-risk entities to ensure absolute certainty. The correct answer is D. Implement a comprehensive enhanced due diligence process for this client, mirroring the requirements for high-risk entities to ensure absolute certainty. Explanation. The assessment process reveals a common challenge in compliance, balancing the need for thorough due diligence with the practicalities of business operations, especially when dealing with a large, established entity like Grupo Mexico. The professional challenge lies in interpreting and applying the relevant regulatory framework, which in this context is assumed to be the Mexican regulatory framework governing financial institutions and anti-money laundering (AML) due diligence, as this is a hiring assessment for Grupo Mexico. The core of the challenge is to ensure compliance with AML obligations without unduly hindering legitimate business activities. The correct approach involves a risk-based due diligence strategy. This means that while enhanced due diligence is required for high-risk customers or transactions, a proportionate level of due diligence is applied to low-risk scenarios. This aligns with the principles of AML regulations, which emphasize a flexible yet robust approach. Specifically, Mexican AML laws, such as those derived from the Ley Federal para la Prevención y Identificación de Operaciones con Recursos de Procedencia Ilícita (LFPORP), mandate due diligence, but also allow for proportionality based on risk assessment. This approach ensures that resources are focused where they are most needed, while still meeting regulatory requirements for all customers. An incorrect approach would be to apply the same level of enhanced due diligence to all clients, regardless of their risk profile. This is inefficient and can create unnecessary barriers to business. It fails to adhere to the risk-based principle inherent in AML regulations, which is designed to optimize compliance efforts. Another incorrect approach is to bypass or significantly reduce due diligence for established clients or those with seemingly reputable background without a formal risk assessment. This is a direct violation of AML obligations, as even established entities can pose risks, and regulatory frameworks require ongoing monitoring and periodic reviews. Failing to do so leaves the institution vulnerable to facilitating illicit activities and incurs significant regulatory penalties. A third incorrect approach is to rely solely on publicly available information without verifying its accuracy or completeness. While public information is a starting point, AML regulations typically require more direct verification and understanding of the customer's business and source of funds. This superficial approach can lead to a false sense of security and a failure to identify red flags. The professional decision-making process for similar situations should involve a clear understanding of the applicable regulatory framework, a robust risk assessment methodology, and a commitment to ongoing training and adherence to internal policies and procedures. When faced with ambiguity, professionals should consult with compliance departments or legal counsel to ensure decisions are compliant and ethically sound. Question 10. Cost-benefit analysis shows that implementing a new automated financial reporting system at Grupo Mexico could significantly reduce operational expenses. However, the system's default configurations do not explicitly align with all specific disclosure requirements mandated by Mexican Financial Reporting Standards, NIF, and the Comisión Nacional Bancaria y de Valores, CNBV. Which of the following implementation strategies best upholds Grupo Mexico's regulatory and ethical obligations? Option A. Delay the full implementation of the new system until a thorough review and necessary customization of its configurations are completed to ensure full compliance with all applicable NIFs and CNBV regulations, even if this incurs additional upfront costs or delays the realization of cost savings. Option B. Proceed with the implementation of the new system, assuming that any minor deviations from NIFs can be corrected through manual adjustments post-implementation, and that the cost savings outweigh the potential for minor reporting inaccuracies. Option C. Adopt the new system's default configurations and seek a waiver from the CNBV for any identified reporting discrepancies, arguing that the cost savings benefit the company and its investors. Option D. Implement the new system with its default configurations and rely on the internal audit department to identify and rectify any compliance issues during their regular reviews, prioritizing the immediate realization of cost benefits. Correct answer is B. Proceed with the implementation of the new system, assuming that any minor deviations from NIFs can be corrected through manual adjustments post-implementation, and that the cost savings outweigh the potential for minor reporting inaccuracies. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, must balance the pursuit of operational efficiency and cost savings with its stringent regulatory obligations and ethical responsibilities. The core of the challenge lies in ensuring that any implementation of new technology or process, even if demonstrably cost-effective, does not inadvertently lead to non-compliance with relevant Mexican financial reporting standards and securities regulations. The pressure to achieve financial targets can create a temptation to overlook or downplay potential compliance risks associated with rapid implementation. The correct approach involves a comprehensive risk assessment and mitigation strategy that prioritizes regulatory adherence. This means that before any cost-saving technology is fully deployed, Grupo Mexico must conduct a thorough review to ensure it aligns with Mexican Financial Reporting Standards, NIF, and any applicable regulations from the Comisión Nacional Bancaria y de Valores, CNBV. This includes verifying that the technology accurately captures and reports financial data in a manner consistent with NIF requirements, and that any changes to reporting processes are adequately documented and communicated to relevant stakeholders, including auditors and regulators. The ethical justification stems from the duty of care owed to investors and the public to provide accurate and transparent financial information, a cornerstone of market integrity. An incorrect approach would be to proceed with the implementation solely based on the cost-benefit analysis, without a dedicated compliance review. This could lead to the adoption of a system that, while cheaper, fails to meet NIF requirements for revenue recognition, asset valuation, or disclosure. Such a failure would constitute a direct violation of CNBV regulations and potentially NIF principles, exposing Grupo Mexico to significant penalties, reputational damage, and loss of investor confidence. Another incorrect approach would be to implement the technology and then address compliance issues reactively. This is professionally unsound as it assumes compliance can be retroactively fixed, which is rarely the case with financial reporting. It demonstrates a lack of proactive risk management and a disregard for the principle of comply or explain, often embedded in regulatory frameworks. Professionals at Grupo Mexico should employ a decision-making framework that integrates compliance and risk management into the initial stages of any strategic initiative. This involves establishing cross-functional teams that include finance, legal, compliance, and IT personnel to evaluate new technologies. A robust due diligence process should be mandatory, specifically assessing the technology's compatibility with Mexican accounting standards and CNBV regulations. If potential conflicts arise, the decision should be to either modify the technology to ensure compliance or forego its implementation until compliance can be guaranteed. The ultimate decision must prioritize regulatory adherence and ethical conduct over short-term cost savings. Question 11. Stakeholder feedback indicates a growing concern among investors regarding the perceived disconnect between Grupo Mexico's reported financial performance and its operational achievements. Some investors are questioning the transparency and accuracy of the company's financial disclosures. What is the most appropriate initial step for Grupo Mexico to take in addressing these concerns? Adhering strictly to Mexican regulatory frameworks governing publicly traded companies. Option A. Advise the investor relations team to engage in direct, informal discussions with key stakeholders to address their specific concerns on a case-by-case basis. Option B. Post detailed operational reports on the company website, hoping that increased transparency in operational data will implicitly address financial reporting concerns. Option C. Immediately issue a press release clarifying the company's financial position and operational successes, emphasizing positive trends to reassure investors. Option D. Conduct a comprehensive internal review of financial reporting processes and operational metrics to identify any discrepancies and ensure compliance with CNBV and BMV regulations. The correct answer is C. Immediately issue a press release clarifying the company's financial position and operational successes, emphasizing positive trends to reassure investors. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under strict regulatory scrutiny regarding its financial reporting and disclosures. Stakeholder feedback, particularly from investors and regulatory bodies, highlights a potential disconnect between perceived operational performance and reported financial outcomes. This discrepancy necessitates a careful and ethically sound approach to address concerns without compromising regulatory compliance or market confidence. The challenge lies in balancing transparency with the need to avoid premature or misleading disclosures that could impact share price or invite regulatory investigation. The correct approach involves a thorough, objective internal review of the reported financial data and operational metrics, followed by a transparent communication strategy that aligns with Grupo Mexico's disclosure obligations under relevant Mexican securities laws and regulations. This approach prioritizes accuracy, integrity, and compliance. By conducting an internal investigation, Grupo Mexico can identify the root cause of the discrepancy, whether it stems from accounting practices, operational reporting, or external market factors. Subsequently, communicating findings and any necessary adjustments in a timely and compliant manner, as dictated by the Bolsa Mexicana de Valores, BMV, and the Comisión Nacional Bancaria y de Valores, CNBV, demonstrates a commitment to good corporate governance and investor protection. An incorrect approach would be to dismiss the stakeholder feedback without a proper investigation. This failure to acknowledge and address concerns could be interpreted as a disregard for investor interests and regulatory oversight, potentially leading to reputational damage and increased scrutiny from the CNBV. Another incorrect approach would be to issue a public statement that attempts to explain away the discrepancy without a factual basis or a clear plan for resolution. This could be seen as misleading the market and violating disclosure requirements, as it lacks the substance and transparency expected of a listed company. Furthermore, selectively disclosing information or attempting to manipulate reporting to appease stakeholders without adhering to established accounting principles and regulatory guidelines would constitute a severe breach of ethical and legal obligations. Professionals in such situations should employ a structured decision-making process. This involves 1. Acknowledging and documenting all stakeholder feedback. 2. Initiating an immediate, objective internal investigation to ascertain the facts. 3. Consulting with legal and compliance departments to ensure all actions align with Mexican securities laws and BMV listing rules. 4. Developing a communication plan that is truthful, comprehensive, and timely, adhering to all disclosure requirements. 5. Implementing corrective actions if deficiencies are identified. This systematic approach ensures that decisions are grounded in facts, guided by regulatory frameworks, and uphold the highest ethical standards. Question 12. System analysis indicates that Grupo Mexico is planning to integrate a new operational data platform with its existing financial reporting systems to enhance real-time business intelligence. The integration involves migrating historical operational data and establishing new data feeds. What is the most appropriate approach to ensure compliance with Mexican financial reporting regulations and internal controls during this implementation. Option A. Rely solely on the IT department's assessment of data integrity, assuming that if the data is accurate within the new platform, it will automatically meet external reporting obligations. Option B. Proceed with the integration, focusing on technical feasibility and data transfer speed, and address any potential reporting discrepancies post-implementation through manual adjustments. Option C. Conduct a comprehensive regulatory impact assessment involving legal and compliance teams to identify all applicable Mexican financial reporting requirements and design the integration process to meet these standards from the outset, including robust data validation and audit trails. Option D. Prioritize the integration of real-time operational data feeds first, deferring the migration of historical data and the full regulatory review until after the initial operational phase is complete. The correct answer is B. Proceed with the integration, focusing on technical feasibility and data transfer speed, and address any potential reporting discrepancies post-implementation through manual adjustments. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's operational needs and the stringent regulatory requirements governing financial reporting and disclosure. Grupo Mexico, as a publicly traded entity, is subject to specific Mexican securities laws and accounting standards. The challenge lies in ensuring that any internal system modifications or data integrations do not inadvertently compromise the integrity, accuracy, or timeliness of financial information reported to regulatory bodies and stakeholders. A failure to adhere to these regulations can lead to significant penalties, reputational damage, and loss of investor confidence. The correct approach involves a meticulous, phased implementation that prioritizes regulatory compliance at every stage. This means conducting thorough impact assessments on financial reporting systems, ensuring data validation protocols are robust, and obtaining explicit sign-off from compliance and legal departments before full integration. This approach is justified by Mexican financial regulation, such as those mandated by the Comisión Nacional Bancaria y de Valores, CNBV, and the Instituto Mexicano de Contadores Públicos, IMP, which emphasize the importance of accurate and reliable financial statements. Ethical considerations also dictate transparency and accountability in financial dealings, which this approach upholds. An incorrect approach would be to proceed with integration without a comprehensive regulatory review. This could manifest as prioritizing speed of implementation over compliance, leading to potential misstatements or omissions in financial reports. Such an action would violate the principles of financial integrity and could contravene specific articles within Mexican corporate law or CNBV circulars that mandate proper accounting practices and disclosure. Another incorrect approach would be to assume that internal data consistency automatically equates to external regulatory compliance. This overlooks the specific formats, validation rules, and reporting deadlines imposed by regulatory authorities, which may differ significantly from internal standards. This failure to recognize the distinct requirements of external reporting would be a significant ethical and regulatory lapse. Professionals should employ a decision-making framework that begins with identifying all applicable regulatory frameworks and internal policies. This is followed by a risk assessment to pinpoint potential compliance gaps. Solutions should then be designed with compliance as a primary objective, not an afterthought. Continuous monitoring and auditing throughout the implementation process are crucial to ensure ongoing adherence. When faced with conflicting priorities, the regulatory and ethical obligations must always take precedence. Question 13. Stakeholder feedback indicates that certain operational cost reporting within Grupo Mexico may not fully reflect the actual expenditures incurred, potentially leading to misstated financial disclosures. Which of the following approaches best addresses this concern while adhering to Grupo Mexico's regulatory obligations? Option A. Instruct the relevant operational teams to adjust their reporting retroactively to align with perceived expectations, without a formal investigation into the initial reporting's validity. Option B. Conduct a superficial review of recent reports, focusing only on areas that appear straightforward, and then communicate that no significant discrepancies were found. Option C. Publicly issue a statement denying any inaccuracies in cost reporting, citing the company's standard accounting practices as sufficient evidence of correctness. Option D. Initiate a comprehensive internal audit and fact-finding mission to verify the accuracy of cost reporting, engaging relevant departments, and reviewing supporting documentation before any external communication. The correct answer is D. Initiate a comprehensive internal audit and fact-finding mission to verify the accuracy of cost reporting, engaging relevant departments, and reviewing supporting documentation before any external communication. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates within a highly regulated environment. The feedback highlights a potential disconnect between operational realities and the company's public disclosures, which could have significant implications for investor confidence, regulatory compliance, and the company's reputation. Careful judgment is required to ensure that all communications and reporting are accurate, transparent, and compliant with applicable Mexican securities laws and regulations, as well as any internal Grupo Mexico policies designed to uphold these standards. The correct approach involves a thorough, fact-based investigation into the stakeholder feedback. This means gathering all relevant documentation, interviewing key personnel involved in the operations and reporting, and cross-referencing information against established procedures and regulatory requirements. This approach is professionally sound because it prioritizes accuracy and compliance. It directly addresses the concerns raised by stakeholders by seeking objective evidence. This aligns with the principles of good corporate governance and the regulatory obligations under Mexican law, such as those enforced by the Comisión Nacional Bancaria y de Valores, CNBV, which mandate truthful and timely disclosure of material information. An incorrect approach would be to dismiss the feedback without proper investigation, assuming it is unfounded or politically motivated. This failure to investigate would violate the duty of care owed to shareholders and the market, potentially leading to non-compliance with disclosure requirements. It also demonstrates a lack of responsiveness to legitimate concerns, which can erode trust. Another incorrect approach would be to immediately issue a public statement refuting the feedback without a thorough internal review. This premature denial could be seen as an attempt to mislead the market if the feedback later proves to have merit. It bypasses the necessary due diligence and could result in regulatory scrutiny for making unsubstantiated public statements. A further incorrect approach would be to selectively address only the parts of the feedback that are easily verifiable or favorable, while ignoring or downplaying more critical aspects. This selective transparency is a form of obfuscation and does not meet the spirit or letter of regulatory requirements for full and fair disclosure. It suggests an intent to manage perception rather than to ensure factual accuracy. Professionals should approach such situations by establishing a clear process for receiving, evaluating, and acting upon stakeholder feedback. This process should include defined roles and responsibilities for investigation, reporting, and communication. A commitment to transparency, accuracy, and regulatory compliance should guide every step, ensuring that decisions are based on facts and adhere to the highest ethical and legal standards. Question 14. Stakeholder feedback indicates a potential operational issue at a key Grupo Mexico subsidiary that could impact future earnings. What is the most appropriate initial course of action for the company's investor relations department? Option A. Conduct a thorough internal investigation to verify the information and assess its materiality, consulting with legal and compliance teams. Option B. Immediately issue a press release acknowledging the feedback and outlining potential impacts. Option C. Advise the subsidiary to address the issue internally without any external communication until it is fully resolved. Option D. Inform only major institutional investors about the potential issue to manage their expectations. Correct answer is B. Immediately issue a press release acknowledging the feedback and outlining potential impacts. Explanation. Scenario analysis. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under strict regulatory oversight. The challenge lies in balancing the need to respond to stakeholder concerns with the imperative to adhere to disclosure regulations and maintain market integrity. Mismanaging this feedback could lead to reputational damage, regulatory scrutiny, and potential legal repercussions if not handled with precision and compliance. Correct approach analysis. The correct approach involves a structured, internal review process that prioritizes factual verification and compliance with Grupo Mexico's disclosure policies and relevant Mexican securities regulations. This ensures that any public communication is accurate, timely, and avoids premature or misleading statements. Adhering to internal protocols and regulatory guidelines for information dissemination is paramount to maintaining investor confidence and fulfilling legal obligations. Incorrect approach is analysis, an approach that immediately releases a public statement without thorough internal investigation risks disseminating inaccurate or incomplete information, which could violate disclosure requirements and mislead investors. This bypasses necessary due diligence and could lead to regulatory penalties. Another incorrect approach would be to ignore the feedback entirely. This demonstrates a lack of responsiveness to stakeholders and could be interpreted as a failure to address material issues, potentially leading to a loss of trust and increased regulatory attention for not acting in good faith. Finally, an approach that involves selective disclosure of information to certain stakeholders while withholding it from others would be a severe breach of insider trading regulations and principles of fair disclosure, creating an uneven playing field for investors and inviting significant legal and regulatory sanctions. Professional reasoning. Professionals at Grupo Mexico should employ a systematic decision-making process. This begins with acknowledging the stakeholder feedback and initiating an internal fact-finding mission. The next step is to consult relevant internal policies and Mexican securities laws regarding disclosure obligations. Based on verified facts, a determination should be made on whether the feedback necessitates a formal disclosure. If so, the communication must be crafted to be accurate, balanced, and compliant with all regulatory requirements, ensuring it is disseminated through appropriate channels to all stakeholders simultaneously. Question 15. Stakeholder feedback indicates that certain operational practices at a subsidiary of Grupo Mexico may be impacting local environmental conditions, a concern that has been amplified by recent media reports. The company's investor relations department is aware of this feedback and is considering how to address it. Which of the following approaches best aligns with Grupo Mexico's regulatory obligations and professional ethical standards for publicly traded companies? Option A. Conduct a thorough internal investigation into the environmental concerns, assess their materiality in accordance with applicable disclosure regulations, and if material, prepare and disseminate timely and accurate public disclosures. Option B. Acknowledge the feedback internally but decide not to disclose publicly, assuming the concerns are localized and unlikely to affect the company's overall financial performance or market perception. Option C. Prioritize addressing the operational issues internally to resolve them before considering any public communication, thereby avoiding potential negative market reactions to the disclosure of an ongoing problem. Option D. Issue a brief public statement acknowledging general stakeholder concerns about environmental matters without detailing the specific feedback received or the company's investigative actions. Correct answer is A. Conduct a thorough internal investigation into the environmental concerns, assess their materiality in accordance with applicable disclosure regulations, and if material, prepare and disseminate timely and accurate public disclosures. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, must navigate the complexities of regulatory compliance while responding to diverse stakeholder concerns. The core challenge lies in balancing the need for transparency and accurate disclosure with the potential for market impact and the differing perspectives of various stakeholder groups. Careful judgment is required to ensure that any communication or action taken is not only compliant with applicable regulations, but also ethically sound and strategically beneficial for the company. The correct approach involves a comprehensive review of the feedback, followed by a structured internal assessment to determine the validity and materiality of the concerns raised. This assessment must then inform a decision on whether disclosure is required under relevant securities laws and stock exchange listing rules. If disclosure is deemed necessary, the company must prepare clear, accurate, and timely information for public dissemination, adhering strictly to the disclosure obligations. This approach is correct because it prioritizes regulatory compliance and investor protection, which are paramount in the financial markets. It ensures that Grupo Mexico acts with integrity and avoids potential penalties or reputational damage associated with non-compliance or misleading information. An incorrect approach would be to dismiss the feedback outright without proper investigation. This fails to acknowledge the potential materiality of stakeholder concerns and could lead to a violation of disclosure obligations if the feedback points to significant issues. It also demonstrates a lack of responsiveness to stakeholders, potentially damaging the company's reputation and future relationships. Another incorrect approach would be to selectively disclose information that favors the company's narrative while omitting crucial details that address the stakeholder concerns. This constitutes misleading disclosure, which is a serious regulatory and ethical breach. It undermines market confidence and can result in severe sanction. A third incorrect approach would be to delay the response or disclosure unnecessarily, hoping the issue will dissipate. This can be interpreted as an attempt to manipulate market perception and is a violation of the principle of timely disclosure. Such delays can also exacerbate the negative impact of the underlying issue and lead to increased scrutiny from regulators. Professionals should employ a decision-making framework that begins with a thorough understanding of the regulatory landscape governing Grupo Mexico. This includes identifying all relevant disclosure requirements and ethical standards. Next, they should establish a clear process for receiving, evaluating, and acting upon stakeholder feedback. This process should involve cross-functional collaboration, including legal, compliance, investor relations, and relevant operational departments. When faced with potentially material information, the framework dictates a systematic assessment of its impact and the determination of the appropriate disclosure strategy, always prioritizing accuracy, completeness, and timeliness in accordance with regulatory mandates. Question 16. The efficiency study reveals that certain operational processes at Grupo Mexico have led to an overstatement of inventory valuation over the past 2 fiscal periods. This overstatement, while not immediately material to the overall financial statements, has the potential to become significant if left unaddressed and could impact future profitability calculations. Which of the following represents the most appropriate and compliant course of action for Grupo Mexico's management? Option A. Immediately issue a press release to the stock exchange acknowledging the potential overstatement identified by the efficiency study, without waiting for a full quantification or audit. Option B. Disregard the findings of the efficiency study as they are not yet material to the current financial statements and focus on future operational improvements. Option C. Initiate a detailed internal investigation to quantify the exact impact of the overstatement, consult with external auditors, and make necessary retrospective adjustments to prior period financial statements and disclosures, if required, in accordance with Mexican Financial Reporting Standards, NIF. Option D. Instruct the accounting department to make a one-time adjustment in the current period's financial statements to correct the cumulative overstatement, without restating prior periods or providing detailed disclosures. The correct answer is C. Initiate a detailed internal investigation to quantify the exact impact of the overstatement, consult with external auditors, and make necessary retrospective adjustments to prior period financial statements and disclosures, if required, in accordance with Mexican Financial Reporting Standards, NIF. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under strict regulatory oversight concerning its financial reporting and disclosure practices. The efficiency study's findings, if not handled appropriately, could lead to misstatements in financial reports, potentially misleading investors and other stakeholders. This necessitates a careful and compliant approach to address the identified inefficiencies. The correct approach involves a thorough internal review and documentation process, followed by appropriate adjustments to accounting records and disclosures, all while adhering to relevant Mexican financial reporting standards and securities regulations. This ensures transparency, accuracy, and compliance, safeguarding the company's integrity and investor confidence. The regulatory framework in Mexico, particularly as it pertains to listed companies, mandates that financial statements accurately reflect the economic reality of the business. Any identified issues that impact financial reporting must be addressed in accordance with these principles. An incorrect approach of immediately publicizing the findings without proper internal validation and accounting treatment would be a significant regulatory failure. It bypasses the necessary steps to ensure the accuracy of the information being disseminated, potentially leading to market manipulation or investor confusion. Another incorrect approach of ignoring the findings due to potential negative implications would constitute a breach of ethical duties and regulatory obligations to report financial performance accurately. This failure to disclose material information or to correct misstatements is a direct violation of securities laws and accounting principles. A third incorrect approach of making arbitrary adjustments without a clear basis or documentation would also be a regulatory failure, as it undermines the reliability and auditability of financial records. Professionals facing similar situations should employ a structured decision-making process. This involves 1. Understanding the nature and potential impact of the findings. 2. Consulting relevant internal policies and external regulations, in this case, Mexican financial reporting standards and securities laws. 3. Engaging with appropriate internal stakeholders, e.g., accounting, internal audit, legal. 4. Developing a plan for investigation, validation, and correction. 5. Implementing the plan with meticulous documentation. 6. Ensuring all disclosures are accurate and compliant. Question 17. Operational review demonstrates that Grupo Mexico has entered into several complex financial derivative contracts to manage currency and interest rate risks. However, the accounting team has expressed concerns about the complexity of classifying these instruments under current accounting standards, suggesting a simplified approach to avoid extensive documentation and analysis. This simplified approach would involve classifying all such instruments based on their initial contractual terms, without a detailed assessment of their subsequent economic performance or potential for early termination. What is the most appropriate course of action for Grupo Mexico's management to ensure compliance and accurate financial reporting? Option A. Adopt the simplified classification approach proposed by the accounting team, focusing on initial contractual terms to reduce administrative burden and expedite financial reporting. Option B. Defer the detailed analysis and classification of these financial derivatives until a later reporting period, when more resources may be available to address the complexity. Option C. Classify all financial derivatives as simple hedging instruments, regardless of their specific features, to streamline reporting and avoid complex accounting treatments. Option D. Implement a detailed classification process for each financial derivative, assessing its economic substance and potential risks according to applicable accounting standards and Grupo Mexico's internal policies, ensuring full disclosure. The correct answer is D. Implement a detailed classification process for each financial derivative, assessing its economic substance and potential risks according to applicable accounting standards and Grupo Mexico's internal policies, ensuring full disclosure. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates under stringent regulatory oversight. The challenge lies in balancing operational efficiency with strict adherence to financial reporting standards and disclosure requirements. A failure to accurately reflect financial instruments can lead to misrepresentation, investor distrust, and significant regulatory penalties. Careful judgment is required to ensure that all financial activities are accounted for in a manner that is both compliant and transparent. The correct approach involves a thorough understanding and application of the relevant accounting standards and Grupo Mexico's internal control policies. This means meticulously documenting the terms of the financial instruments, assessing their classification based on their economic substance, and ensuring that all associated risks and potential impacts are appropriately recognized and disclosed in the financial statements. This aligns with the principles of fair presentation and transparency mandated by financial regulations, ensuring that stakeholders have an accurate view of the company's financial health. An incorrect approach that involves overlooking the nuances of financial instrument classification for simplicity would be a direct violation of accounting principles. This could lead to misstated financial results, potentially misleading investors and analysts about Grupo Mexico's true financial position and performance. Such an oversight would also fail to meet the disclosure obligations required by regulatory bodies, exposing the company to sanctions. Another incorrect approach, which is to delay the recognition of potential losses until they are definitively realized, ignores the principle of prudence in accounting. Financial reporting requires the recognition of anticipated losses when they become probable and estimable, even if not yet certain. Failing to do so inflates asset values and understates liabilities, creating a misleading financial picture. This also breaches the duty to provide a true and fair view, as required by financial regulations. A professional decision-making process for similar situations should involve a systematic review of all financial transactions, against established accounting standards and company policies. This includes seeking expert advice when dealing with complex financial instruments, performing thorough due diligence, and maintaining robust internal controls. The ultimate goal is to ensure that financial reporting is accurate, complete, and compliant with all applicable regulations, thereby upholding the integrity of the company's financial disclosures. Question 18. Upon reviewing the initial proposal for Grupo Mexico's potential acquisition of a significant stake in a publicly traded subsidiary in a new jurisdiction, what is the most prudent and compliant first step to ensure adherence to all relevant securities laws and corporate governance guidelines? Option A. Proceed with the acquisition and address any regulatory concerns that may arise during the integration phase, prioritizing speed to market over upfront regulatory scrutiny. Option B. Immediately proceed with the acquisition based on the preliminary financial due diligence, assuming existing internal legal counsel can address any post-acquisition regulatory filings. Option C. Inform the market of the potential acquisition through a press release to gauge public interest and potential investor reactions before conducting any formal regulatory assessment. Option D. Initiate a comprehensive review of the target jurisdiction's securities regulations and engage specialized external legal counsel with expertise in cross-border and regulatory compliance to assess the transaction's feasibility and requirements. Correct answer is B. Immediately proceed with the acquisition based on the preliminary financial due diligence, assuming existing internal legal counsel can address any post-acquisition regulatory filings. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to expand its market presence and the stringent regulatory requirements designed to protect investors and market integrity. Grupo Mexico, as a publicly traded entity, must navigate these regulations meticulously. The challenge lies in ensuring that any new business initiative, particularly one involving potential public offerings or significant financial transactions, strictly adheres to the applicable regulatory framework without compromising business objectives. Careful judgment is required to balance commercial ambition with legal and ethical obligations. The correct approach involves a proactive and comprehensive engagement with the relevant regulatory bodies and legal counsel from the outset. This ensures that all proposed actions are vetted against current laws and guidelines before implementation. By seeking pre-clearance and expert advice, Grupo Mexico demonstrates a commitment to compliance, minimizes the risk of future penalties or reputational damage, and builds trust with regulators and stakeholders. This aligns with the fundamental principles of corporate governance and regulatory adherence expected of listed companies. An incorrect approach that proceeds with the expansion without thorough regulatory review risks significant legal and financial repercussions. This could include fines, sanctions, or even the suspension of trading for non-compliance with disclosure requirements or market conduct rules. Another incorrect approach, that of relying solely on internal legal opinions without external validation or direct engagement with regulators, is also problematic. While internal counsel is valuable, regulatory bodies often have specific interpretations and expectations that may not be fully captured by internal assessments. Furthermore, attempting to circumvent or interpret regulations in a manner that favors business expediency over strict adherence is a clear ethical and regulatory failure, potentially leading to accusations of market manipulation or misleading practices. Professionals facing similar situations should adopt a framework that prioritizes understanding the regulatory landscape, seeking expert advice, both internal and external, engaging proactively with regulatory authorities, and documenting all compliance efforts. A risk-based approach, where potential regulatory hurdles are identified early and addressed systematically, is crucial for successful and compliant business operations. Question 19. Strategic planning requires Grupo Mexico to integrate its new ambitious sustainability targets into its financial reporting framework. Considering the regulatory landscape in Mexico, which approach best ensures compliance and investor confidence when disclosing the financial implications of these sustainability initiatives? Option A. Implement robust internal controls and accounting policies to accurately capture, measure, and report the financial costs and potential economic benefits of the sustainability initiatives, ensuring consistency and reconciliation between financial statements and any supplementary sustainability disclosures, in line with CNBV guidelines. Option B. Publicly announce significant projected cost savings from sustainability initiatives in press releases to generate positive investor sentiment, without waiting for these savings to be fully realized and audited within the financial statements. Option C. Focus on qualitative descriptions of sustainability progress in all public communications, avoiding any specific financial figures or projections to prevent potential misinterpretations or future discrepancies. Option D. Develop a separate, unaudited sustainability report detailing the environmental and social benefits, while the audited financial statements focus solely on traditional financial metrics, with minimal mention of sustainability costs or gains. The correct answer is D. Develop a separate, unaudited sustainability report detailing the environmental and social benefits, while the audited financial statements focus solely on traditional financial metrics, with minimal mention of sustainability costs or gains. Explanation. This scenario presents a professional challenge because Grupo Mexico, as a publicly traded entity, operates within a highly regulated environment. The implementation of new sustainability initiatives, while ethically commendable and strategically beneficial long-term, must be carefully balanced against immediate financial reporting obligations and investor expectations. The challenge lies in ensuring that the communication and accounting for these initiatives are transparent, accurate, and compliant with all applicable Mexican securities laws and accounting standards. Misrepresenting the financial impact or the progress of these initiatives could lead to regulatory scrutiny, investor distrust, and potential legal repercussions. The correct approach involves a comprehensive and integrated strategy that aligns financial reporting with sustainability disclosures. This means establishing clear internal controls and processes to accurately track and report the costs and benefits associated with the new sustainability programs. It also requires ensuring that all public disclosures, whether in financial statements or sustainability reports, are consistent, verifiable, and comply with the disclosure requirements set forth by the Comisión Nacional Bancaria y de Valores, CNBV, and relevant accounting principles. This approach upholds the ethical duty of transparency and the regulatory obligation for accurate financial reporting, fostering investor confidence. An incorrect approach would be to prioritize the immediate financial reporting of the sustainability initiatives without adequate substantiation, or to disclose sustainability progress in a manner that is not reconciled with financial realities. For instance, overstating the immediate financial benefits or understating the costs of these initiatives in financial reports would violate accounting principles and potentially CNBV regulations regarding financial misrepresentation. Similarly, presenting sustainability achievements in a way that is not supported by verifiable data or that creates a misleading impression of financial impact would be ethically unsound and could contravene disclosure guidelines. Another incorrect approach would be to segregate sustainability reporting entirely from financial reporting, leading to a disconnect that could confuse investors and obscure the true financial implications of the company's strategic decisions. Professionals should approach such situations by first conducting a thorough assessment of all applicable regulations, including those from the CNBV and relevant accounting standards. They should then develop clear internal policies and procedures for data collection, verification, and reporting related to sustainability initiatives. A cross-functional team involving finance, legal, and sustainability departments should be established to ensure alignment and consistency in all disclosures. Regular internal reviews and audits should be conducted to ensure compliance and accuracy. The decision-making process should prioritize transparency, accuracy, and adherence to regulatory frameworks, ensuring that all stakeholders receive a true and fair view of the company's performance and strategic direction. Question 20. Market research demonstrates a significant opportunity for Grupo Mexico to introduce a new investment advisory service. The marketing department proposes a campaign that emphasizes the potential for high returns and innovative strategies, with a brief mention of standard market risks in the footer of a digital advertisement. The compliance department is concerned that this approach may not adequately inform potential clients about the specific nature and extent of risks associated with this new service, potentially violating regulatory guidelines for financial promotions. Which of the following approaches best adheres to regulatory requirements and professional ethical standards for Grupo Mexico in this scenario? Option A. Develop a revised marketing campaign that clearly articulates the specific risks and potential downsides of the new advisory service, alongside its benefits, ensuring all disclosures are prominent and easily understandable to the target audience, and subject to thorough review by the compliance and legal teams before dissemination. Option B. Proceed with the marketing campaign as proposed by the marketing department, as the mention of standard market risks is sufficient to meet disclosure obligations, and the focus on potential returns is crucial for attracting clients. Option C. Delay the launch of the new service and marketing campaign indefinitely until a more comprehensive understanding of all potential market fluctuations and client risk tolerances can be achieved to ensure absolute certainty in all promotional claims. Option D. Focus the marketing campaign solely on the innovative strategies and potential benefits, omitting any mention of risks to avoid deterring potential clients, and relying on the client's own due diligence to understand any associated downsides. The correct answer is B. Proceed with the marketing campaign as proposed by the marketing department, as the mention of standard market risks is sufficient to meet disclosure obligations, and the focus on potential returns is crucial for attracting clients. Explanation. This scenario presents a professional challenge for Grupo Mexico's compliance team due to the inherent tension between competitive market positioning and the stringent regulatory requirements governing financial promotions. The need to highlight a new service offering while adhering to specific disclosure and fairness mandates requires careful navigation. Professionals must balance the imperative to inform potential clients about valuable new services with the absolute necessity of avoiding misleading statements or omissions that could violate regulatory standards. The challenge lies in crafting promotional material that is both effective in attracting business and fully compliant with the law. Correct approach involves a comprehensive review process that prioritizes regulatory adherence. This includes ensuring all claims made about the new service are substantiated, that any associated risks or limitations are clearly and prominently disclosed, and that the overall presentation is fair and balanced, avoiding hyperbole or selective information. This approach is correct because it directly addresses the core principles of financial promotion regulation, which aim to protect investors by ensuring they receive accurate, clear, and complete information. Specifically, it aligns with the spirit and letter of regulations that mandate transparency and prohibit deceptive practices, thereby safeguarding both the company's reputation and the public interest. An incorrect approach that focuses solely on aggressive marketing without adequate regulatory scrutiny would fail by potentially misrepresenting the service's benefits or downplaying its risks. This could lead to violations of regulations requiring fair and balanced promotions, potentially resulting in significant fines, reputational damage, and client dissatisfaction. Another incorrect approach that delays or omits necessary disclosures to streamline the marketing process is also professionally unacceptable. Such an approach directly contravenes regulatory requirements for timely and complete information, exposing Grupo Mexico to regulatory sanctions and undermining client trust. A third incorrect approach that relies on vague or aspirational language without concrete evidence to support claims would similarly fall short, as regulations often require specific, verifiable information in financial promotions. Professionals should employ a decision-making framework that begins with a thorough understanding of the applicable regulatory framework for financial promotions. This involves identifying all relevant disclosure requirements, prohibitions against misleading statements, and standards for fair presentation. Before any promotional material is released, it should undergo a rigorous internal review by compliance and legal departments. This review should assess the material against the regulatory checklist, ensuring all claims are accurate, all risks are disclosed, and the overall message is balanced. If there is any doubt about compliance, the material should be revised or, if necessary, not used. This systematic, risk-averse process ensures that business objectives are pursued within the bounds of legal and ethical conduct.